All right. Hello, everyone, and welcome to today's webinar, The Unwinding Carry Trade and its Impact on DeFi Lending. This is, some would think kind of a pretty narrow topic to cover, but it's actually super impactful for the DeFi landscape. And, I think we have three of the smartest guys who are going to share their perspectives on it. And so, great to have you guys here. And, I'll let you each kind of just briefly introduce yourselves, and then each of you have some prepared remarks. But Sam, you want to start off introducing yourself?
Yeah, hey everyone. My name is Sam. I'm the founder of Frax. Frax is a decentralized stablecoin issuer and DeFi platform, and also developers of the Fractal blockchain. And yeah, glad to be here. I think I was here originally like years ago, Lou, when
Yeah,
Frax was just starting. So good to be back.
exactly. It was you were on one of the early episodes of Stablecoins Are Killing It in 2020.
And they're still killing it, right? Even
I
bigger.
gotta say, yeah, I think I was right. But great to have you back. And Kory?
Yeah, for sure. Thank you so much for having me on, Lou. So I'm Kory. I'm the CEO and co-founder of Stably. I'm also one of the core project contributors to dTRINITY, which is the first subsidized stablecoin lending protocol live on Fraxel L2. I've been working with the Frax team and our team on this project for about a year now, and yeah, would love to tell you guys more about stable coins, DeFi lending, carry trade, and all that stuff based on our background, my background experience of almost 7 years now in the stablecoin industry. So glad to be here.
Yeah, but well, obviously both you guys are true OGs in the stablecoin space. And then Liam, last but not least, with Morpho, and Liam, thanks. You were really the genesis for the call.
Yeah. Great to see you guys, Lou. Thanks for having me on. It's a pleasure to be here as well. I lead BD, or like I'm like the BD lead here at Morpho. We're the second largest lending protocol on chain. Between Ethereum and Base, we have about 5 billion in total deposits. I've been in the space now for about 6 years. It's been quite a ride, and yeah, I come to represent the lending side of the conversation, which is very much intertwined with stablecoins, and how we're seeing kind of like the unwinding effects of the carry trade in DeFi. So yeah, excited to talk about this with you guys. There's a lot of kind of considerations around like Morpho's protocol development, that we've taken inspiration from kind of, the carry trade, and, trying to make DeFi more applicable to the masses. So anyways, thanks for having us, and I'm excited to get going.
Okay, nice to have you here. And I know right before you were with Morpho, you were with Sarson, VC. And I always think it's great for VCs to go and get experience operating.
This is true. Yeah. Sarson Funds was my first go around in the space, and they've taught me a lot. I've got a lot of appreciation for John.
Yeah, I say VCs who haven't operated are like sex therapists who are virgins. It doesn't make sense. But in any case, with that, I will pass it over to Sam, who'll be the first to give comments on the topic today of the carry trade and its impact on DeFi.
Sure, yeah. I wanted to kind of set the actual background. So like usually I don't know how either involved or not certain audience members are, but what I like to actually just talk about is like first the backdrop of all this stuff is stable coins that need to basically either scale or need to actually grow in like a large amount. So the story with stable coins, if people don't know, like the history is Tether started in like 2014, and initially there was this thing called the Signer shares white paper, which is like the first white paper for algorithmic stablecoins, saying that you can have this two-token model where there's a share token and a stablecoin token, and that's an alternative to just dollar-backed this tokenized dollar that the Tether was doing, right? And so a couple years pass, and then MakerDAO creates the what people call the CDP model, where you over collateralize crypto collateral in smart contracts, right? Like $1 million of Ether, and then you can mint like 500,000 stable coins. So it's like backed by a larger amount of things, and that's the main decentralized way to mint a stable coin. In that backdrop, then Frax, our first version, which is not how it works anymore, is like a hybrid of the Signer shares model and then the MakerDAO model, which is this protocol-owned liquidity is in AMMs. And then it so turns out that Terra tries the Signer shares model. Terra Luna, as people know, doesn't end up working, right? And then in this backdrop, Frax actually has worked really, really well. The original V1 that we've made is never depegged for like any reason in terms of algorithms or protocol and liquidity. But this is the backdrop where in this kind of long-term thing, Arthur Hayes had this like blog post where he said, hey, there's these types of stable coins, right? The dollar ones that are just tokenized, the MakerDAO style like CDPs, some forms like Frax that seem to work, but they're kind of riskier and things like that. And what would be really cool that no one's tried is creating a stable coin that's backed by the carry trade. And the carry trade, like as we know, is a delta neutral position, basically, so that even though you have Bitcoin collateral or Ether, like let's say you have some Ethereum or Bitcoin, someone's used to like mint your stable coin, it's not over collateralized. What it is that you take some of it and then you go to a perpetuals or future exchange, and then you short your exposure to the Bitcoin using it as collateral. And so now you have a delta neutral position. And usually, because this is called the carry trade. Usually you get paid to go short these cryptocurrencies. And so you have this open trade that you let people mint your stablecoin, which is like Bitcoin or Ethereum. I think Athena started only with Ethereum at first when Guy and the team approached me and told me about this. I'm actually an investor. I love the team. I think they're one of the seminal parts in the history of stablecoins. And then you do this carry trade. Usually it's positive. Usually when you short something, you get paid in the cryptocurrency landscape. Technically, that's not always the case, right? And I think this is what we're talking about with the unwinding of the carry trade, which is when this goes negative, you're actually paying to go short to carry trade to neutralize your volatility exposure to the underlying Bitcoin and Ethereum you hold, right? And this just for in this background, kind of in this context, I actually, from all of that I know, since we've talked last time, Lou and everything, Frax has actually launched a new stablecoin called FRXUSD that is entirely T-bill and cash backed, preparing for the new legislation in the United States to be payment stablecoin compliant, legal tender. And so I think that's probably a good answer to what I think about all of these unique mechanisms, both from the ones Frax invented to what MakerDAO originally invented, these over collateralized CDPs and the carry trade, is that I think they're really good innovations, but I don't think any of them by themselves, or to be honest, even combined, are a scalable way to create safe digital dollars on the base layer. That's what I think. Like, even though right now we're having this conversation that the carry trade is unwound and things, I'm sure in like 3 months, 7 months, 9 months, whatever it is, right? The market will rip, and then like the carry trade will be really profitable again, right? 20, 30%. But
People pile into it.
yeah. And that's great. That's fine. Just like how right now we're talking about the unwinding of it or something, right? But it is not actually the way that there's no mechanism other than having very safe, structured, bankruptcy remote, institutionally custodied cash and treasury bills or Fed reverse repos or dollars, essentially, to scale digital dollars, real digital dollars, especially given with the legislative clarity that's about to come, which I was in DC actually giving feedback and talking with Senator Haggerty and Lummis, who are the two authors of the Genius Act, the stablecoin legislation, the Senate version of the bills. I think that that's the future. These are great. These are great ways to actually create yield for DeFi holders of dollars. Not right now, because it's like a little bit bearish and it's unwinding. But I think that my take on it is that especially with our experience at Frax, creating a stable coin that A has never lost people's money. In terms of it hasn't imploded like Terra or anything, has done a lot of innovations, and created a lot of firsts in the DeFi industry, and has seen Athena and seen it's awesome. And I'm actually an investor. We have a partnership with them for carry trade yield for the Frax ecosystem. So it's a great thing. It's not how you get to, in my opinion, and I think they know this too because they're working with BlackRock to do this second stable coin called USTB. That's not how you get to 10, 20, 100 billion supply and higher. So that's kind of how I see it. I think, the unwinding is temporary. It'll come back. It'll unwind again. And then it'll come back. But it's more of a savings offer essentially for like DeFi users based on market conditions rather than a real way to generate near scalable digital dollars, which I don't think in my experience I've seen done properly other than just holding digital dollars like in like a treasury account or something and then tokenizing them.
Sure. So thanks a lot for those comments. And generally, when we hold these calls, we let each of the speakers go, and then we do Q&A. But I know that unfortunately, you can only be with us for the first half hour today. So I'll do a little Q&A before hand it off to the next speaker. And that's the most interesting. Where are you today on then the outlook for algorithmic stablecoins?
I think that they're gonna be well, so everyone's definition of algorithmic stablecoins is actually different. Most people think of algorithmic stablecoins as something like Terra. I actually
No, but yes, I think let's assume that this is a sophisticated group of people who understand what an algorithmic stablecoin is.
Yeah, so my definition is stablecoin that's on chain that uses algorithms and smart contracts. So programmatic strategies of like stablecoins. In fact, like I think hopefully Kory isn't against me saying I think DUSD is an algorithmic stablecoin because that's
Partially algorithmic. Yes.
Yeah, and it's backed. There's nothing like, there's nothing Terra Luna going on. It's just using smart contracts to do market operations, use algorithms and code. We call it like just open market operations, right? And so I think they'll be M2 or M3. That's my opinion. So for people that and that aren't well versed on the economic like lingo, M1 money is basically like literal non-hypothecated digital or like dollars, right? Like actually in the traditional financial space. M1 is like Federal Reserve notes, like cash. M1 and M0 are usually synonymous. So like you just say like M1, and then literally direct deposits of Federal Reserve notes, right, dollars into banks or banks holding dollar deposits at their Federal Reserve account. M2 is one hypothecated, right? M2 is like when, you deposit $1 million in your bank, the bank shows in your login you have $1 million, but then the next guy comes and asks the bank for a mortgage, and then the bank gives them a $500,000 mortgage. And so now in this guy's account, it says $500,000. In your account, when you log in, it still says $1 million. The bank doesn't say, hey, we took your money, right? So now there's $1.5 million. That $500,000 is M2. Like this second one from the guy that got the mortgage, that is M2 money. Now, obviously, there's like no one really knows this unless they're like economists or understand it. They just see dollars in a bank. They just see like your bank shows $1 million, his shows 500K. He'll pay that to like the house he's buying, and then the other guy will see 500K in his bank. But it's M2. It didn't start out with real dollars. I see algorithmic stablecoins as M2. That's what I see. That's why no matter what happens, if you look at like all of these designs from the original Frax, again, that we don't use, we have Frax USD now.
But importantly, it worked.
It worked. Yes,
Yes.
it definitely worked, but it's not scalable in the sense that I don't think an algorithmic stablecoin will get to $1 trillion without using digital dollars that are the M1. So like this, what I was saying is like Frax used USDC, MakerDAO's USDS basically has mass majority of things in USDC. Which is
what a great name.
very very good name indeed. And then like everyone has to use M1 money and then create the M2. So my opinion of algorithmic stablecoins is that it is M2 or M3, depending on how risky or how many times hypothecated it is. So the reason we're doing FRX USD, Frax USD, and getting the payment stablecoin charter and following all of these activities in DC is that I think the base money in crypto on chain in like the blockchain era, right, in this probably the century or at least the next couple decades at minimum, is going to be digital dollars, like literal digital dollars, and then soon to be legal tender digital dollars. If you read the Genius Act and the stablecoin legislation, it literally says payment stablecoins can be used as bank settlement media. That obviously doesn't mean it's like a Federal Reserve note that's like all debts public and private, but technically nothing else is today either. When that guy has 500K in his bank account that he got from mortgage, that's not actually all debts public and private. It's bank deposits, CDs that are M2 that are legislatively anointed as legal tender. This stablecoin bill is actually literally, if you go read it, which I have multiple times from front to cover, giving feedback to the authors and everyone in the process, it is legal tender in that sense. It is literally on the same level as a bank deposit. And banks can actually take things like Frax USD and I assume USDC and USDT, they'll get the payment stablecoin charter and stuff, and they could take them as literal deposits. Like you could go to a bank. The bank isn't forced legally, but if they accept stablecoins or they issue their own, if it's a payment stablecoin and it's chartered, they can just take it as literal cash. So I think that's the future of the M1 of digital dollars, and then the algorithmic stablecoins are like the M2 and M3, which doesn't mean they're like less profitable. It means it's just a different layer on top.
Sure. For me, I believe Loomis and Gillibrand, that they are being thoughtful about what they're proposing and that it would be helpful to the industry. Do you have a view? But I don't have really a view on the administration.
I only make comments about crypto related policy, and try not to get into the large aspects of
No,
policy.
I'm just talking about the administration with regards to crypto policy. I'm not
Oh,
asking
it's great.
about anything else.
Honestly, I
Yes.
cannot be more happier. The administration's crypto policy, obviously you can say like different things or whatever, but it is pretty much they are the Bitcoin, the crypto admin, the things that they've done to fix and actually get right on making actually America the crypto capital of the world, I could not think of how to do it better. Honestly, I know everyone has like super high opinionated stuff about this or that, but from every way that, you know, to put it through politics to fix the SEC issues, to do market structure or get started on market structure, regulatory clarity, to get the stablecoin stuff out the door. But the last thing I'll say about the stablecoin stuff is I think there's a lot of confusion in how the legislation will work, which is like basically the main thing is that everyone thinks it means something different than it does because they read, for example, the yield, like there's this clause that says like payment stablecoin issuers can't give yield or something. That's like a common one that I see people complaining about, and they think it's this conspiracy that like Circle and Tether are benefiting from and all this stuff. I think people just don't understand. They don't have the context where A, you wouldn't want to give yield on the base digital cash anyway. You can give yield in like promotional programs, right? Like for example, how Circle and Coinbase team up to give rewards in USDC that are very close to the risk-free rate, right? But the USDC token that's represented as a digital dollar, that's not increasing in price. That's not something that's like rebasing or like some kind of thing because A, if it was,
I know you're not a fan of rebasing.
yes, well, and I think I was proven right, by the way. But
Yes, no, I'm not. Yeah, I'm not disagreeing with you.
yeah, well, I think like the thing people miss is like the yield will go back to users 100%, whether it's through rewards, a competitor, or a like a strategic partnership with distributors, right? Like
Right.
what Circle has
And
with Coinbase.
either to the borrower or the lender.
Yes, exactly. Right. But then the thing is, if you had a digital dollar that the token itself represented a varying risk-free rate, and I know Liam and Kory probably can really weigh in like when after I have to go because they're experts in this area. No one would lend this, right? No one would lend a digital payment stablecoin, something that let's say is legal tender, but was giving away of the risk-free rate inside of the token. Like the token represented both the base digital dollar and this
Yep.
variable risk-free rate that is whatever the T-bill short overnight rate happens to be. No one would lend that in Morpho or dTRINITY, and that's my view. Or if they would, it would be really underutilized or like not used and popular as just normal digital dollars, USDC, FRX USD, or any of these things. And this bill actually tries to help people highlight that and just
Yep.
give them the just base primitive of a dollar. It doesn't say you're not allowed to give yield in other outside additional, you know, rewards programs or something. It just says the literal digital representation that the payment stablecoin issuer is going to issue, it cannot give yield to its holders, which is like a legally strict, low scope clear definition because of how strict laws have to actually like talk about. So there's no interpretation issues. The Genius Act, in my opinion, is very good. So I really commend
Yeah.
Senator Haggerty and Lummis for it. The Stable Act, I have some problems, but since that one's so new, it's probably unfair to judge it because it has to go through about a couple months of markup from annoying people like me, people in DC, people in the industry talking about it and stuff, but it'll probably end up becoming really good too.
Okay, last question because I know you got to go. I'm encouraged by your thoughts on the administration and their policies. Well, actually, two questions. First, do you think that the Bitcoin reserve will actually ever buy any Bitcoin? And have you had a chance to interact with David Sachs?
I have not directly one-on-one spoken with David Sachs yet. I have talked with multiple people, like Scott Bessent and Senator Lummis and their roundtable for the stablecoin bill. I have not talked to David Sachs, but I have been at their roundtable where him and a whole group of guys were talking about budget neutral ways to actually, like you said, purchase Bitcoin, but not directly use the incoming treasury revenue, because I think that probably will not get enough bipartisan support to be able to do that, especially in a time where whether we think Bitcoin is good or not as an investment, which obviously we do, it's a little bit difficult if you're cutting everyone's jobs and trying to lower the deficit of the government and then using it to buy Bitcoin. So I do think there will buy a lot of Bitcoin, but in a budget neutral way. There's a lot of gold certificate redenomination. There's a lot of budget savings where part of it gets allocated to the Bitcoin Strategic Reserve. That I was actually in a working group talking about that, and like in the roundtable with Saylor, all of these guys, David Bailey, the Bitcoin Policy Institute in DC. They're amazing. They're really championing all this stuff. I think it'll happen, but I don't think it'll be, oh, here's a bunch of tax income, let's just like, God candle it into BTC. I think in like maybe H2 2026 is when my guess would be. People underestimate how slow consensus building is in government, even though so much stuff has happened fast for crypto. Once you really get into the let's allocate money, whether it's budget neutral, whether it's from somewhere else or not, that's when things really get into political negotiations.
Sure. No, that makes a lot of sense. Look, thanks for taking the time today. I realized you have to go, and hopefully it won't be so long till the third time.
Yeah, great to be on. Great to
Yeah.
see you guys too, Kory and Liam, and talk to you soon. Take care, guys.
Cheers, Sam. Take care, man.
So yeah, thanks guys for that. Yeah, obviously having Sam on is epic. Wanted to leverage him while we had his time. And next, Kory, turn it over to you.
Yeah, for sure. I guess just to kind of follow on to what Sam was talking about regarding algorithmic stablecoin, I like to make a clear distinction. I do agree with him that all algorithmic, whether fully algorithmic or partially algorithmic, should be considered part of the so-called M2 money supply, right? The total money supply, up into that level. However, within that algorithmic stablecoin category, there needs to be a distinction to be made between endogenously backed algorithmic stablecoin versus exogenously backed algorithmic stablecoin. Because the algorithm is just the on-chain mechanism to execute various smart contract actions, right, in order to operate this stablecoin. What actually gives a stablecoin its value, whether algorithmic or not, is the reserve backing ultimately, right? In the case of Terra Luna, for example, that was an endogenously backed algorithmic stablecoin, meaning it was backed by its own effectively future cash flow, right? If you want to think about it in a sense like that, which is, endogenously backed stuff is actually what is restricted in the upcoming stablecoin regulation as well, right? Because there's a lot of potential danger in doing that, as has been demonstrated historically through a lot of these projects who have attempted to create endogenously backed stablecoin. Exogenously backed stablecoin, whether they're payment regulated or algorithmic or partially algorithmic, these are actually a lot more stable and more long-term sustainable, because the reserve itself is other other assets from outside its ecosystem, right? It could be T-bill, it could be other stable coins.
Right, endogenous is bullshit, right? I mean, you right. I don't know if I ever told the story. I had Andy Singleton, the DeFi expert at the collective, go in and read Terra Luna, right, and read the code and what it does. And so he read it, told me what it does. Okay, I get it. 6 months later, it implodes. CNBC called me on, and the first question they asked was, "Hey, was Terra Luna a Ponzi scheme?" And I said, "Absolutely not." I said, Terra Luna was a Ponzi strategy. A scheme is when they lie to you about what they're doing.
Yeah, exactly. But it was endogenous, right? Meaning it was backed by its own promise.
Right, but you knew it would implode if at some point it was.
Hey, for what it's worth, the US dollar is no longer exogenously backed, right? It used to be backed by gold. Now the US dollar is
sure. Right. And we know with 100% certainty that at some point the US dollar is going to zero as well. Correct?
Yeah, we'll see. We'll see about that. Hopefully the current administration can help turn that around, right? We'll see.
Yeah, I mean, the deficit's going up. It's not going down. At least, at the moment.
Yeah, we can all hold our breath and wait and see what happens,
Yes.
right? So that's my distinction that I want to clarify there, right? Not all algorithmic stablecoins that are the same, especially the ones that algorithmic stablecoins, they are innovation, right? They're at the forefront of this DeFi revolution, and the way that they're designed, determines pretty much, and the way that the reserve backing is designed, right, pretty much determine the long-term sustainability and viability of those projects.
I was surprised. It seemed like Sam was kind of backing away from algorithmic stablecoins.
No, he's not.
I
mean, they're still. So this is why I want to make that distinction, right? They're moving away from a hybrid model where it was mostly exogenously backed and a little bit of endogenously backed. They're moving from that model to a model where it is fully exogenously backed, right? But it's still operated by algorithm. The algorithm can manage these exogenous collateral and market operations.
Exactly. Yes.
That's what the algorithm is for, right? On-chain, automation of various market mechanisms. It doesn't necessarily mean that an algorithm equals endogenous collateral. That's the distinction.
Okay, well, that's an important distinction, right? I mean, right? Because my assumption is that an algorithm can do it better than a Federal Reserve banker.
That's a very fair assumption or argument to make. That's why the DeFi is this where the innovation could happen, right? And we can test it out. So I do want to kind of take the conversation back to the carry trade and also give some historical backdrop that will segue very nicely into DeFi lending, right? Which is where Liam can step in and provide a lot of expertise with his background in Morpho. So Sam was particularly talking about the DeFi carry trade, right? Regarding like Athena, cash and carry strategy. Well, what is a carry trade, right? A carry trade is effectively when you borrow money at a cheaper cost and reinvest it in something else that pays more. That's effectively what it is, right? And maybe you borrow to get you borrow and then you collateralize that asset to borrow more of that same money for cheap, and then you go buy that asset again, right, to increase your exposure in it.
What do they call that?
It was called yield looping, right? In DeFi, we call it yield looping. In traditional finance, it's always been called the carry trade, right? So Japan, since the 90s, the late 80s, right? They've been, flooring their, they had a big, economic recession or depression, if you will, since like the early 90s, right? And they've been flooring their interest rate for the yen to like almost zero, to basically zero, right? They had zero interest
for years and years and years.
For decades, right? For decades. And finally, in the past year or so, it's finally started to unwind. Well, probably more than the past year, but it's starting to unwind where now the Japanese central banks is starting to, increase the rates again. And that is causing a lot of people to unloop, right? Many institutions, many investors for decades, they have been piling in a lot of debt on Japanese debt in order to reinvest that debt elsewhere that pays more, right? So now they have to unloop, right? Because it's starting to be more expensive. So now that's, okay, they unlooping. Where are they going to loop next? What are they going to use to borrow to start looping again next, right? They got to go find another source of cheap credit in order to, enable to implement their strategies again, right? So that's where now we have DeFi, which is very, a whole new industry. And, it has a lot of similarities to the traditional finance sector, traditional markets. And that's where also DeFi lending and borrowing step in, right? It enables credit. Borrowing and credit expansion, which could be a great venue to conduct these type of carry trade in the DeFi space. Platforms such as Aave, Compound, or even Morpho, right, facilitate lending and borrowing. And we have our own lending protocol, which is called DLend, which also facilitate this, right? But the key question here is, can DeFi create better interest rate than traditional finance? right? Can DeFi offer better yield and lower costs effectively, right? Now, risk-wise, DeFi definitely is a little bit higher risk, right, than traditional finance. So there's always that risk premium that has to be baked in, but risk adjusted wise, right? Can DeFi offer higher yield and lower borrowing costs to to these traditional finance unloopers that now got to look for something to reloop, right? So maybe Liam from Morpho could definitely chime in on this this opportunity that is now emerging in the DeFi space.
Yeah, for sure. Great tee up. Thanks, Kory. I think just to kind of add a preface here too, I think the first kind of like wave that we all felt by the unwinding of like the carry trade with the yen and like the Bank of Japan and everything was back in August, right, when I think there was a crazy sell-off of longer tail equities and crypto assets and all that. And since kind of these, or like DeFi is the forefront of innovation, and a lot of these builders in this space are see the vulnerabilities in the traditional system and are building mechanisms to figure out how to do it better. So I think like at least my observation of the unwinding of like the traditional carry trade over the course of the last year or so, it's influenced a lot of DeFi protocols to figure out how to deliver like better, more efficient yields. This kind of is inclusive of stablecoins, but extends to lending protocols and like other kind of yield generation sources in DeFi. I think there's kind of two main ways that people are attempting to kind of like replicate traditional-esque opportunities in DeFi and make them better. One of which is, like I said, figuring out how to deliver more efficient rates. This is something that Morpho has thought a lot about, same with dTRINITY as well, with like their yield-bearing stablecoin. Frax was also organized or built very similarly at the start with like their intentions for yield-bearing underlying assets. But so first with that, like stablecoins, like we talked about, like or especially yield-bearing stablecoins, are being used to loop these opportunities in order to capture the spread between the borrow and the lend APY. On the other side of this, we also have figuring out like how to make DeFi a more traditional like lending experience, where unlike the first model of lending on chain, where it was more like peer-to-pool models, we have, which is what Morpho has introduced, these risk isolated lending markets that allow people to kind of pick and choose the collateral exposure that they want their loan assets being exposed to. So this is one big thing where it's like in traditional markets we don't have these peer-to-pool models where all of a lender's assets are fully exposed to this pool of assets and collateral that are all kind of commingling and have much more of a collective risk of bad debt exposure. But then also too, like outside of this risk isolated lending model, we also have the question of like, why should anyone in these traditional markets that are looking for better yield opportunities, why should they use DeFi? Like these protocols are much less battle tested. They are prone to hacks. We've seen, I don't know, maybe Kory, you have a better idea of this than I do, but like multiple billions of dollars worth of hacks in DeFi protocol vulnerabilities over the course of the last several years. And so I think that, risk and protocol security need to be, equally as important in, in kind of influencing future protocol design as, is the opportunity to give more efficient and better rates to make DeFi more attractive, for these institutions and these larger players. It's not just the yield, it's also about security. So this is like also too something that Morpho considered pretty heavily in our design, where our contracts are completely immutable, so there's no ability to upgrade them. We've been live for 18 months now with no hacks, and we think that this kind of immutable approach around reducing the points of vulnerability or vectors of attack as much as possible when it comes to these protocols, or else we'll continue to kind of see the same intrinsic issues that we've seen over the last several years as DeFi has grown more popular, with more and more hacks. So minimizing hacks, maximizing yield, this is kind of the delicate balance that I think DeFi is dancing right now.
Yeah, I agree a lot with what Liam has said. So what Liam essentially here is reducing risk, right? DeFi, naturally is a lot higher risk than traditional finance, with tech risk, exploit, drains and things like that, right? So figuring out how to reduce those risks is very essential in increasing the overall risk-adjusted return or yield, right, of the investor. And so platforms like Morpho has definitely done a very good job at that, which is why projects like us, dTRINITY, even though we have our own lending protocol, we would love to partner with Morpho here in the near future to bring our own stablecoin products and open up lending markets over there too, right? There's a lot of positive partnership and collaboration that we could work toward, and in order
there's definitely appetite for this. Definitely
right, and adding benefits for everyone. So Liam has touched on what Morpho has been doing in order to reduce risk, and and doing that you can improve the overall risk-adjusted return, right? What I would like to touch on is the other the demand side of the equation, which is borrowing costs, right? So when people, as you said, when they supply Athena or these yield-bearing assets into lending protocol, they're supplying it, right? Now they have to borrow something else, right? They have to borrow another stablecoin or something else in order, as the debt instrument, in order for them to access liquidity and leverage, right? So often they would borrow another non-yield bearing stablecoin. And as Sam has mentioned earlier, nobody wants to borrow a yield bearing stablecoin, because the yield bearing stablecoin, that yield, it accumulates as extra debt on your loan position, right? So it's actually more capital inefficient for you to borrow a yield bearing stablecoin versus borrowing a regular vanilla, non-yield bearing stables, right? So that's why, for the most part, a lot of yield bearing assets, like Athena, SUSDE, or other yield bearing stable coins like StakeDAI, or SUSDS, they get deposited or supplied to lending protocols, but most of it gets left underutilized, right? No one borrows these yield bearing assets. That actually creates capital inefficiency and underutilization, right? So what us at dTRINITY have been working on is figuring out a way in order to solve that, right? In order to do that, we actually launched our own stablecoin called DUSD, dTRINITY USD. And DUSD is a decentralized stablecoin, full reserve, right? It's fully backed by an exogenous collateral of other yield-bearing assets like Frax USD, StakeDAI, right? And this reserve generates yield, and we do not externalize this yield to the holders of the DUSD token, because if we did that, we would be sending it to the supply side again, right? What we're doing is we're sending this yield to the borrowers of DUSD, whether it's borrowers of DUSD on our lending protocol, DLend, or one day DUSD borrowers on Morpho, right? They will receive interest rebates, right? Not a yield payment, interest rebate, which is a borrowing discount, Okay, I just want to make that clear distinction there. Legally, the lawyers can debate on that, but we're not paying yield. We're paying out interest rebates to the borrowers of DUSD, which effectively reduces their borrow APR, right? Now, this creates a beautiful complementary dynamic versus, yield-bearing stablecoin, which is paying yields to the holders, right? Because now we have something that supply side focus, and then we have DUSD, which is demand side focus, right? Think of it as the yin and the yang coming together, right? Borrowers of DUSD, which is the denominator asset, right, can now use it as a cheaper medium of leverage in order to access more exposure, to acquire more of the yield-bearing stables, which is the numerator asset, right, in this equation. So that means that, demand for both sides is going to increase, right? Both for DUSD, which is a demand side focus stablecoin, and, Athena, Stake Frax, or Stake DAI, whatever that people is looping, right? That is a supply side asset. So by doing this, it also actually unlocks higher utilization and demand, right? So people borrow more. And because of higher utilization, DUSD lenders, right, whether it's on Morpho or DLend, they now get higher yields comparatively versus, if they were just lending vanilla stablecoin like USDC or USDT, right? So in combination with what Morpho is doing and, reducing risk, right, and what dTRINITY doing is reducing borrowing costs, right? Combined, now we can actually create something that is quite attractive, which, for a traditional finance investor that is unlooping from that traditional carry trade. Now they can look into DeFi and they can say, holy cow, I can borrow DUSD and not pay any interest. I might even get paid to borrow DUSD. That's crazy, right? Like, that's even better than the Japanese yen at some point, right? If it's able to scale. And, and yield paying opportunities in DeFi on the supply side, right, is plenty, right? There's Athena with the, delta neutral strategy. There's CDP project that is, basically lending projects that are paying, lending yield. There's restaking, there's a lot of innovations in DeFi that's able to generate, above market return that is not, seen in traditional finance, right? So all in combination, these are all very strong tailwind that is going to catalyze the adoption of DeFi among, these traditional unloopers that I think is now going to, explore new opportunities in the coming years.
Yeah. I totally agree with Kory's mental model too, around the intention and the purpose behind yield-bearing stablecoins. Like kind of on the surface level, like the most clear reason for this, like Kory said, is to make borrowing cheaper and kind of like create the grounds for this flywheel where we can kind of replicate these carry trade opportunities in DeFi in a more genuine way. But then also too, like Kory said, is that with the backing of DUSD being these multiple blue chip yield bearing assets, this I think is also something that is really important to consider too for these traditional investors looking for a better home or a like replicable source of yield in DeFi, is where unlike these assets that are kind of only exposed to the depreciation or appreciation of the yen or the US dollar as like its only kind of backing, right? We now have these DeFi assets that are kind of where the collateral is decentralized in a way, right? Where we don't have this sole exposure on just one collateral type that can be made vulnerable, or can make a protocol or an asset vulnerable that's built on top of it, but rather like kind of segregating the risk and like the yield opportunities of the underlying collateral in order to give kind of like a more trusted and reliable source of yield in the case that like one of those assets is negatively affected, like the yen, the US dollar, etc. And the protocols or the assets built on top of that underlying basket of assets kind of can have some more stability and maintain the strength of their foundation with the other assets that are kind of in that basket of collateral as well. So anyways, like this is definitely something that we're thinking about a lot too in Morpho. We see a lot of these kind of carry trade like opportunities as well with like Pendle tokens, SUSDS, and others that are also being used as collateral on Morpho to kind of like reduce borrow costs in a sense. Not the same way as we're mapped out with the USD, but you know, these are all things that we are considering heavily and, you know, preparing for as we expect to host kind of like the next generation of institutional onboarding. Like, you know, lending markets are the show when it comes to, you know, institutional interest. And, you know, this I think is is, you know, one of the biggest, if not the biggest, maybe besides stablecoins, opportunities for DeFi to kind of you know, gain some positive traction here in the world. So yeah.
Yeah,
Yeah, I like to add to this as well. I think one of the thing that is missing in DeFi right now is the DeFi space has very been supply side focused, right? Look at where all the opportunities are accumulating to. Who are they accumulating to? They're accumulating to the lenders or to the holders of yield-bearing assets, right? And these are the very same people who loop them, right? Who to carry trade opportunities and who leverage on them by borrowing something else that's cheaper, right? No one has really focused on, you know, or should I say, really successfully focused on the demand side. We have projects, stablecoin projects, you know, in DeFi and a few years ago that actually, you know, attempted to solve this problem by, you know, doing things like fixing the borrowing rates, right? But when you do things like that, it's like, you know, it's like communism, right? You can't fix the borrowing rate, the interest rate, right? You have to let it be free flowing to be market based, because when you fix it, you create imbalances in the ecosystem that is eventually gonna either drain your stable coin or depeg it, right? One of the two. And you know, if everything balances out, then you know you're gonna lose a lot of TVL. Your stable coin might not be depeg anymore, but you'll lose a lot of TVL and this won't be sustainable, right? Or if the stable coin, if you want to keep the TVL, then your stable coin is going to depeg, right? So when you fix your interest rate like that, is you know, not scalable nor sustainable, right? So there have been projects that are trying to solve this problem unsuccessfully. We are, you know, a new project at dTRINITY. We're a new project that's trying to focus on this demand side as well, right? One of the, you know, the side that is most untackled in this space, right? And our solution to this problem is not to fix the interest rate or do anything that might be considered, you know, command economy or like, you know, plan economics, right? What we're doing is we're actually taking market-based yield and redirecting it to the borrowers in order to subsidize them, right? And by doing so, it actually creates more demand and more utilization, which leads to higher yield for lenders as well. So, you know, whatever we gave out to the borrowers, that we give up to the borrowers as subsidy, it actually comes back to the lenders in the form of higher lending yield and utilization, right? So it's a very like novel, you know, market-based, supply and demand-based mechanism that doesn't, you know, rely on fixing rates in order to lower the borrowing cost, right? There needs to be more innovation in DeFi, similar to what we're doing, in order to lower the borrowing costs for the borrowers. Because when you successfully do that, that's how you grow an economy, right? When the Federal Reserve lower interest rate, economy boom, right? People can borrow more, invest more, and do more things, right? Similarly in DeFi, if we can figure out, you know, if the whole industry, you know, not just dTRINITY, but, you know, more and more projects start trying to figure out how to focus more on the demand side and, you know, while at the same time continue to innovate on the supply side, right? As we have been doing. I think that's kind of like one of the missing pieces in the DeFi space that I haven't seen really like big innovation in, which, you know, in the coming months and year, you know, I'm very excited to see what's going to unfold.
No, makes a lot of sense. I'm looking forward to it as well. So we're coming up to the top of the hour. Liam, I'll start with you. Any last words you want to leave with folks? You're on mute. There you go.
I'm thinking. I would say that Yeah, I would say maybe to reiterate, but also dig deeper into this. You know, it is the responsibility of you know, builders in DeFi to you know, figure out how to deliver a better system for the world. This is like all that we've been intending on for, you know, the last what, 16 years now in crypto. And you know, it's our responsibility to continue like upping the ante, continue pushing on like how we can make this system applicable for everyone, and for like especially these large traditional players that will like truly move the needle. This is our focus at Morpho is you know, onboarding these institutional players and, you know, delivering to them the safe, reliable yield that they get in traditional markets. And we're not going to stop till we get there. So so anyways, like
Awesome.
we're always open to jam. We're always open to ideas, and you know, please reach out if there's anything that that we can do together.
That's great. How should they reach out to you?
I can share my Telegram and my email in the is there a comment section or chat?
Yeah, you should be able to leave a chat.
Here, right here. Telegram. And then my email is this.
Yeah, sorry I didn't get to your question, Praveen.
Awesome. Thanks a lot, guys.
Usually we get to questions from the audience, but that wasn't how it rolled out today. But I thought it was a super interesting session. And Kory, last minute words.
Yeah, I guess I'm just going to plug dTRINITY a little bit here. So, you know, we are the first subsidized stablecoin lending protocol in DeFi. You're not going to find anything else like what we have built on Frax.L2. So check out dTRINITY.org. A lot of our users have been telling us that it's like they found a cheat code in DeFi. They're borrowing. They're borrowing for either like 1 or 2%, or as of today, actually, they're borrowing for negative interest, negative borrow APR.
Yeah, you're getting paid to
borrow,
borrow. Right? Can I borrow $1 billion?
Right? So come check out what we're doing, you know, learn more about what we're doing. I think most people will find it very novel and innovative, and they'll come to like it, like many of our community members who are now, you know, joining our community, our Discord, and, you know, it's growing every day. We're very active in there. So, you know, I'm happy to answer anyone's questions and you know, address any comments or concern or whatever about our projects in Discord. So yeah, you can check us out at dTRINITY.org. That's dTRINITY. And then there is also discord.gg/dTRINITY.
Awesome. Thanks, Kory. Thanks, Liam. Thanks, everyone.
Awesome.
Thanks for having us, Lou. Cheers.
Yeah.
Take care.